Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us for this segment, we have Chuck Fuller, Portfolio Manager with Nasdaq Dorsey, Wright, to discuss asset class rankings with international equities moving ahead of U.S. equities. Chuck, it is great to see you as always. Welcome back to Trade Talks.
Yeah, great to see you too.
And Chuck, if I recall correctly, this is the first time since you and I have been covering this together where international leapfrogged ahead of U.S. equities.
Yeah, it is. And actually, it's the first time that we've seen international up this high in a long time. It's at number 2 in our asset class rankings right now, and that's really the first time since 2010 that it's been this high. So it's definitely unparalleled, at least for the last decade or so.
Let's talk about short-term indicators, right? They were extended last time we talked. They've cooled off a bit. Are markets near oversold levels? What are your indicators showing?
Yeah, they're not really at what I would say are oversold levels right now. They definitely moved off those highs where they were last month. They're lower than they were, but we're also in a bear market, and those kind of indicators tend to get much lower when they're in a bear market than when you're in kind of a normal either sideways or bull market. So I hesitate to say that they're oversold to the downside too much at this point. There definitely could be some more pain.
And let's talk about sector rankings, right? What is number one and what has moved up the most to the upside?
Yeah. So they've mostly been stable over the last month, but we're seeing still energy at number 1. We've actually seen basic materials move up to number 2, which has been kind of interesting. It was at number 4 last month. The previous month it was at number 7. So it's been the one that's really moved up the most. And then we have consumer staples at number 3. And so, those are all like fairly defensive sectors that you would expect to see, given the kind of market that we've had. The biggest mover to the downside that we've seen, and it wasn't that much, is financials. It moved from number 2 to number 4, over the last month.
Yeah, that is interesting because the financials and energy were kind of the sectors that were working this year. And over the past month, financials is just certainly a reversal of fortune there. Let's talk about international equities for one more moment here, because Sure. A lot of it is predicated on what you're seeing happen with commodities.
It is, right? So commodities pulled back quite a bit over the last month. They were in the number 2 spot in our asset class rankings. Crude oil is down about 13% over the last month, and a lot of commodity indexes are heavily weighted towards crude. And so, we saw commodities kind of fall from number 2 to number 4 in the asset class rankings. That allowed international, because it has been doing so well over the same period of time, to move up and kind of leapfrog past U.S. equities.
And it's so interesting, fixed income, the best performing asset class over the last month, which had the worst start of the year of all asset classes.
Yeah, I mean, it's been just a terrible year for fixed income. But yeah, over the last month, it's been up about 2.3%. And rates, they pull back, decently. We've kind of posted 2 lows around, the 3.45% area. If you're looking at the 10-year, the next support below that would be 2.75%, which is hard to imagine we'd see that anytime soon. But with the CPI was good this month, and really the last 5 months, if you kind of annualize it, it's been running at about a 2.5% rate. And so my view is that inflation is at least started to ease. I'm not saying that it's all gone and we don't have to worry about it ever again, but the more that it does ease, the more the recession risks become, or get pushed more to the forefront. And so that could cause some continued downward pressure on rates.
What remains number 1 in your rankings?
In fixed income, yeah. So in fixed income, we've got, high yield is still at number 1 in our rankings. We haven't seen too many, major notable changes over the last month, but we have seen, a bit of a weakening in defensive sectors, so things like short duration treasuries, municipals, inflation protected debt, and a strengthening in offensive sectors like corporates and long duration treasuries. The last couple of days, we've seen the opposite of that. Rates have kind of spiked, and so those haven't done as well. But in terms of relative strength, those are still where we're seeing the most strength.
Finally, let's wrap up with commodities. It really seems as if the past couple of months we've seen pretty significant reversals of fortune in many of these asset classes.
Yeah, we have. Like we said, it's moved from number 2 to number 4 for us, and spent most of the year at number 1. And so there's definitely been some kind of changing of the guard here. As I mentioned, most of that's from crude oil kind of falling out of bed. What's interesting though is that other areas of the commodity space have picked up. So we've seen where energy is actually fallen to last place in our sub asset class rankings for commodities. We've seen precious metals now move up to number one. So think of things like gold and silver and whatnot. Interestingly, it's more or less been a silver and platinum play. They've had big moves over the last month. Gold, much less so. But not just precious metals. We've also seen industrial metals move up as well. They're actually number two in our rankings now.
All right, Chuck. Appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.